Rumors of bank collapse have been all over the news and YouTube recently, and many financial analysts are predicting a collapse in banking institutions similar to 2008 or worse. In this collapse, not all banks will be hit equally, so how can you know which banks are safe and which ones will go under? In this video, we're taking a look at one banking company with a multi-decade history of dividend payments and a major advantage over big banks in the upcoming collapse. So make sure you stick around till the end of the video to discover why this bank is here to stay. Every day, we dig for dividend-paying companies that present huge opportunities for long-term investors to get into high-quality stocks at low prices. And today, it's Community Trust Bancorp Incorporated, or CTBI. Each week, there's at least one stock that's trading at a discount, so subscribe and turn on notifications to take advantage of these opportunities as they arise. Community Trust Bancorp Incorporated is a bank holding company that operates through its subsidiary, Community Trust Bank Incorporated. The bank offers a range of financial services, including commercial and personal banking, as well as trust and wealth management services. CTBI generates revenue by charging interest on loans, earning interest on deposits, and collecting fees for various services. One of the primary ways CTBI makes money is through lending. The bank provides loans to both individuals and businesses, charging interest on the amount borrowed. The interest rate charged on loans is typically higher than the interest rate paid on deposits, allowing the bank to earn a profit on the difference, known as the net interest margin. CTBI's loan portfolio includes a variety of loans, including commercial real estate loans, consumer loans, and agricultural loans. In addition to lending, CTBI also generates revenue by earning interest on deposits. When customers deposit money into their accounts, the bank can use those funds to make loans or invest in other financial instruments that earn a higher rate of return. The interest paid on deposits is typically lower than the interest earned on loans and investments, allowing the bank to earn a profit on the difference. CTBI also collects fees for various services, such as account maintenance fees, overdraft fees, and wire transfer fees. These fees provide an additional source of revenue for the bank, although they typically represent a smaller portion of the bank's overall revenue compared to interest income. With a clear understanding of how CTBI serves its communities and generates revenue, we can now take a deeper dive into the history of their dividend, financial growth, and the sustainability of their dividend distributions. First, we'll look at the key metrics of CTBI's dividend distributions, namely their current yield, dividend growth, and dividend increase streak. The dividend yield is calculated as the total annual dividend divided by the current share price, and represents the returns an investor can expect in dividends. CTBI's current yield is 4.84%, which is higher than their 5-year average yield of about 4%. This increase in yield comes as a result of a 6-month slide in share price, which we'll discuss in a later section of this analysis. The dividend growth is calculated by measuring the compounded growth rate of the dividend amount in US dollars over many time periods and illustrates the income growth an investor can expect while holding a stock. Ideally, we want to see historical dividend growth between 8 and 12%, but at a minimum this growth should be greater than 4% over a 10-year time period. CTBI's 10-year dividend growth rate is 4.6%, and their 3-year dividend growth rate is 5.9%, indicating they're growing their dividend at an increasing rate. The dividend increase streak represents the number of consecutive years a company has raised its dividend and depicts a company's commitment to shareholder distributions and income growth. I don't invest in companies that have an increase streak shorter than 10 years. The longer the streak, the better. CTBI has raised their dividend every year for the past 43 years. This is an impressive streak and lands them firmly in the category of Dividend Champion. Next, we'll look at the sustainability of the dividend by analyzing their payout ratios. A payout ratio is calculated by dividing the total dividend distribution by some income metric over a given time period, typically on an annual basis. Low payout ratios indicate a safe dividend since the company is paying out less than they're earning, while a payout ratio above 100% could mean a business will need to cut its dividend soon to continue normal operations. I generally consider payout ratios below 75% to be safe, as this allows for market downturns and drops in income without jeopardizing the dividend. CTBI's payout ratios on net income, operating cash flow, and free cash flow all remained below 46% over the past 5 years, and they haven't paid a dividend with negative earnings any of those years. Even on a quarterly basis, Community Trust hasn't crossed the 75% mark but once back in Q1 of 2020, which I think we can excuse them for given the state of the world at the time. Lastly, we'll look at the financial growth of CTBI by analyzing their annual and quarterly income statements, balance sheets, and statements of cash flow. Specifically, we'll look at the 5-year trendline growth of net income, operating cash flow, and free cash flow. In general, growth in these metrics above historical inflation of 2 to 3% indicates a healthy business and ensures the long-term viability of the company. CTBI has had strong financial growth over the past 5 years, with all income metrics growing at over 10%. I'm particularly impressed by the free cash flow growth, which has been growing at 12.3% since 2018. From 2018 to 2020, Community Trust did put up negative operating income numbers, but over the past 2 years has boosted these numbers up to almost $26 million in 2021 and a little over $4 million in 2022. Given the strong growth in income, I expect CTBI to continue to grow its dividend at or above their 10-year historical rate. This growth, coupled with the extremely safe payout ratios, indicate to me a banking stock dedicated to stable and growing dividend income. The banking collapse of 2008 and the recent collapse of Silicon Valley Bank was fundamentally a problem with debt management. These banks took on too much leverage without the income to back it up and ultimately became insolvent. The debt-to-equity ratio is a measure of a bank's allocation of debt. The larger the ratio, the more the bank is leaning on debt to finance its operations and earn a profit. A low DE ratio indicates the bank is utilizing equity from shareholders more than it is debt, which is generally considered to be a safer practice. DE ratios over 2.5 indicate a bank is taking on too much debt and would be at risk of default during a market downturn. CTBI's current DE ratio is 0.1, indicating a heavy reliance on shareholder equity over debt to generate profits. Given that the current average debt-to-equity ratio for financial institutions in the United States is 2.3, this positions Community Trust as one of the safest banks to weather the upcoming financial crisis. The Tier 1 leverage ratio compares a bank's Tier 1 capital to its total assets to evaluate how leveraged a bank is, and it's employed by bank regulators to ensure that banks have enough liquidity on hand to meet certain requisite stress tests. A ratio above 5% is deemed to be an indicator of strong financial footing for a bank. CTBI's current Tier 1 leverage ratio is 13.1%, which is almost 4 percentage points higher than the industry average. Regulators require banks to maintain a leverage ratio above 3%, indicating that CTBI is not only meeting regulations but also well insulated from a potential market downturn. So how much can we actually earn investing in CTBI? Let's take the values we just discussed over to MarketBeat's dividend calculator and see what we get. If we invest $1,000 in CTBI today with a 4.84% dividend yield, 5.9% dividend growth, and a 3% annual share price appreciation, our yield on cost will be nearly 40% with an average annual return of 8.6%. The yield on cost is calculated by dividing the annual dividend by the total investment over a given time period, and the average annual return represents a combination of share price appreciation and dividend distributions over the same time frame. Even though the initial yield is less than 5%, dividend reinvestment steadily increases your yield on cost and average annual return over time. Over 20 years, almost $3,400 worth of dividends would have been paid, and we would earn $473 on the 20th year. The market sentiment surrounding banking stocks has caused a 6-month slide in CTBI share price, causing the yield to spike near 5% for the first time in almost 5 years. I believe they're getting caught up in a panic sell-off that they don't belong in, opening the door for smart investors to buy in at low prices. Given the safe payout ratios and strong financial growth, I don't expect Community Trust to cut their dividend anytime soon. The low debt-to-equity ratio and the high Tier 1 leverage ratio also makes me comfortable knowing that if a bank collapse epidemic is coming, CTBI should be able to weather the storm with ease. CTBI has a very good outlook in terms of financial security and dividend safety, but not nearly as attractive as UGI. This energy company is truly a diamond in the rough. I'm very surprised it's been trading this low over the past couple weeks. To check out our analysis of this stock, click on the video card here. Every week we find more stocks like this one trading at huge discounts, so make sure you subscribe and turn on notifications so you never miss a golden opportunity. As always, stay safe and take it easy.